dive into the topic today. Okay, as you can see here in my presentation, today we are going to talk about the moving averages and the way that we can apply them on our chart, and also some simple strategies that we can extract from these magical, simple moving averages. But during this session today, I will provide you with a definition of the moving averages, the types of them, and we will get to understand their application. Also, we will see how we can use the moving averages to define the market direction, and also to measure the trend's momentum, which are both of them are one of the most important things that we need prior in triggering any trading, actually. And at the end of the webinar, we will talk about let's say the common trading strategies that we can use with moving averages. And of course, you can send your question to me anytime, and I will get there as soon as possible. First of all, let's start with what we usually talk about at the beginning of each session. That's the why education matter. Actually, trading successfully is not about good luck or chance. So we need to think about what we want to do with our investments and how they will fit into our financial plan even before we place our first trade. That's why the education matters, because better understanding of the market needs to consistently learning in the financial markets, because you see the pace of the development in this market is too fast. So being prepared for trading will help us survive in this very fluctuate environment as the financial markets. But against all of the risks and everything that might happen, I firmly believe that anyone can learn to successfully trade with the right tools and guidance. That's why we try to serve you with these weekly webinars, and I really hope you enjoy it. And please take the education serious, because what you can learn in this market can help you to survive in some unpredictable circumstances. But let's start with the understanding of moving averages. What are moving averages? Moving averages, as a definition, we know them as the technical indicator that we use to determine the direction of a trend over a specific time period. They are moving averages because they calculate the average of price movements over a period of time, a specific period of time. We call them moving because they are continually recalculating and updating themselves regarding their formula. They are kind of the statistical tools. And so because of that, we call them the moving averages. One of the most important benefits of the moving averages is that they help us to define the market direction, because we know many times prices are fluctuating very choppy. They're not going in a straight line, and in that term, it could be very confusing for many, specifically for beginner traders, to get the market direction, to identify actually the trend in the market. And one of the other most important privileges of these moving averages are that they help us to measure the trend's momentum. We know in the trending market, anytime the trend might actually reverse, so it's very important to not involve in the trend at the ending stages. There we might lose, and market will actually just go against us. So before that we get to the calculation and the usage of the moving average, let's discuss the definition of market direction, because we know the market is moving in three ways. We call it the uptrend, downtrend, and sideways. The uptrend market, or let's say the uptrend, simply occurs on the chart when we see prices are going in a let's say consecutive higher tops and higher bottoms, when they forming actually the consecutive higher tops and higher bottoms. For example, here you can see after each upward movement a correction occurs and forms a bottom there, and after that we have another top and then another bottom. We call it an uptrend when we see the consecutive higher tops, because we know the prices actually don't move in a straight line. So it's very important to notice that we are not looking for those just upwarding movement in the market, because we know any trend, doesn't matter it's an uptrend or downtrend, actually consists of both movements together, upward movement and downward movement. But the important thing is that if the direction of these fluctuation in upward and downward movements is going to be up or going to be down, that's actually that makes the market direction. And in an uptrend we are looking for higher tops, as you can see here on my presentation, and higher bottoms. On the flip side, we have the downtrend when we see the market actually forms consecutive lower tops and lower bottoms. That means you see during the price fluctuation and moving up and down, we can just identify the tops and bottoms that are occurred lower relative to each other. Which together actually they make a downtrend. So this is the up and down movement of the price, forming a lower tops and lower bottoms that enables us to identify a downtrend. But when we can't recognize the higher tops or lower tops or higher bottoms and lower bottoms, we see them. We say the market is moving in sideways. It means there is no detectable distancing tops and bottom, or let's say we see one top is higher than the previous and then the bottom is lower than the previous bottom. So this confusing picture shows that the market is not trending, it's trendless, or we call it a sideways. In that situation, we see usually prices are going in between the two lines, or let's say in a range actually bounds. If I want to show you on the live market, for example here, We see USD CAD in 1 hour time frame, and you can see here that these higher tops, we can recognize them on the chart easily, and these higher bottoms actually together they have formed a very beautiful upward movement as an uptrend. You see, when we have this top and then this higher top just comes, and then we have this bottom, and then this higher bottom came. So it shows we are in an uptrend. We can get a better picture if we zoom out a bit and looking for a downtrend. Yeah, for example, this is a very short downtrend. We can see here as we see this top and then this bottom somehow has formed, and then we see the higher top and a lower top and a bit lower bottom, which actually form a downtrend, this construction together forming a downtrend. But the important point to keep in mind is that we should notice the trend, uptrend or downtrend, actually is intact unless the last top or bottom just penetrated. For example, here we see this bottom here. We can say that this uptrend is intact, is still in play, unless we see a penetration or break below this bottom, which is the last bottom here. And also vice versa, in a downtrend, it's very important to have the downtrend intact when we see consecutive lower tops and lower bottoms. But once the breakout occurs on the chart, we see it as a reversal or the end of the downtrend. For example, here you can see that when this last top here penetrated by the price with going off, then we can say the downtrend has been ending at this course. And to find a good example for range market, you can see here that we have some tops and some bottoms. What we really can say which one is higher or they are not in a consecutive relation with each other, as we can see here. For example, this is the higher top, and then this is our bottom, but we see a lower top, but then the higher bottom, and then the higher top related to the previous one, and then in that case it's very confusing picture of market action, and you can't actually identify any trend here. That said, it's very recommended. We should prevent trading when we can't recognize the trend, okay? Because as an old saying in the financial markets, the trend is our friend. So when we can't identify the trend, it's better to stay away of the market and don't trade. Once we can actually identify any kind of trend, downtrend or the uptrend, then that would be a good place to look for opportunity to trade. And that's this is the reason that we use the moving averages, because in many cases you see the market doesn't move in a straight line, and you can see it's not very easy to identify all the tops and bottoms relatively in a consecutive way against each other. And that's why we use the moving averages in the market to identify the trend direction. Okay, let's back to our presentation. Okay, let's talk about the types of moving averages, because we are going to know which moving average would be the best for us to apply on our chart and to let's say involve it in our trading strategies. Together, we need first to know about the types of moving averages. There are 4 types of moving averages. Let's start with the simplest one, which is the simple moving average. Okay, the simple moving average is a straightforward technical indicator that is obtained by summing the recent data points in a given set and dividing the total by the number of time periods. It means, for example, if we have 20 prices, or we want to calculate the moving average for 20 trading sessions, which each session actually comes with one closing price. Let's say we have 20 prices, and if if we sum all of those 20 prices and then divide them by 20, which is the number of the data that we have, or number of prices, we get a parameter there called the simple average of all those 20 data. Okay, that's the simple moving average with a very simple calculation. If you want to actually apply a simple moving average on your chart, you can just go to your navigator window and then double click on the moving average under the trend category in the indicators, and then you see this window just pops up. Here you can choose the period for your moving average, let's say the 50, and then you can choose the method of the MA. That's the type of your actually moving average, as a simple, exponential, smoothed, and linear weighted. With the simple moving average, if we apply it on our close prices, we just leave this appearance here as a blue color with this actually line here, and then click on the OK. You see this actually line appears on my chart. And what does it mean? It means at each point, for example, here at the last trading session here, you can see a moving average comes with a number stated here, the value of 1.28030. Okay, this is the value of the moving average, and then you see the current price is here down below this moving average. It means at the 1.27, let's say 740. Okay, it means if I sum all the 50 close prices during the past sessions, for example, till here, okay, these are the 50 prices. If I sum all of these closing prices and divide them by the 50, I get the number at here about the 1.28. And when I see the price is far below this average, it means price is actually moving down far away from its average. It means a bearish setup is very likely. This is just a way to show you how what does it mean actually to if we compare the price to the moving average value. The moving average value, so as a simple moving average shows the sum of the 50 data for 50 closing prices divided by the 50. Okay, this is a simple moving average. But we have also the next type, which is the exponential MA. Exponential moving average is the other type of moving average, which gives more weight to the most recent price point to make it more responsive. Because the most important thing in financial markets is we think that the recent development, the recent changes in price have more, let's say, impact on the near future. Because, for example, when we look at the prices right here, you see, we can say that, the USD CAD is going down sharply, so it means we carried more than what has happened, for example, in 15 period ago, or let's say in the yesterday or last week. Okay, the recent data is more important for traders. That's why we need something to show us the let's say to give them more weight to the most recent data, or to the most recent price changing. This is the reason that we use the exponential moving averages. For example, if I want to put the exponential moving averages here on my chart, I can just double click on the moving average, choose the exponential. Let me change the color to get the better picture to you, as a red one. And if I click on the OK, you see here the exponential moving average is a relatively closer to the prices. It means when we are actually at the recent data, if we zoom in a bit, you can see here, for example, recently this exponential moving average has been closer to the prices than this simple moving average. And then we see the prices going up sharply, for example, somewhere here. Let me just clear my chart to overwhelming thing. Okay, you see, for example, when the prices actually moved sharply here, the reaction of this red moving average, which is the exponential moving average, has been faster than the simple moving average. This is what we expect to have in the market, because we want to be updated as much as possible, and we want to be at the let's say top of the price changes in the market to make more wise decisions. Okay, so this is the advantage of the exponential moving average compared to the simple moving average, that we have that it actually reflects sharply, or actually faster than the simple moving average. The third one is a smoothed MA, that giving the recent prices an equal weighting to the historical ones. This type of moving averages are also are very useful for some trading when you want to let's say clear noises in the market, and you want to have a very smooth price movement, especially during the let's say long period of time. You can use these smoothed moving averages. The formula is very similar to the exponential moving average, only with the longer period applied usually. To smooth the price movement, let me apply it on the chart and see the differences between them. It's let's choose a color as a green maybe, and when I put OK, you see it just this smoothed moving average filters all the noises from the price fluctuation, and you see it's moving in a very smooth way, far from the recent prices, because it more focuses on the, let's say, the whole period of price fluctuations. As you can see here, when price going sharply up or down, you see the less reaction from this smoothed moving average compared to the exponential one, which is the fastest, and this a simple moving average, which is the actually something between them. So the advantage of using this moving average is that it can filter all the noises, and then I can get a better picture or clear picture of the market, regardless the let's say short-term fluctuation or price movements. And you see, for example, during this downtrend here, you see this one is far from this actually smoothed moving average is far from the prices compared to this exponential and these simple moving averages. Okay, but let's get to the last one. The linear weighted moving average is one of the most overlooked moving averages, and I don't know, interestingly, people don't see this linear weighted moving averages usually, and I don't know why, because I'm going to show you how sensitive this moving average is to the price changes. A linear weighted moving average is a moving average calculation that more heavily weights recent price data, even more than the exponential moving average. The most recent price is the highest weighting, and each prior price has progressively less weight. The weights drop in a linear fashion. You know, in this case, you can see that the linear weighted moving averages reveals as fast as possible, reveals all the price changing as fast as possible in the market, and they can give you a very, very fast update about the market movement and the price action. Let's put one of these linear weighted moving averages on the chart on the 50 period, and let's choose a black color for that. If I press OK, you see how sensitive is how sensitive this moving average is, and you can see it's moving very, very close to the prices and reflects any minor price movements. You can see it's very, very sensitive compared to other types of the moving averages. So you see we have 4 different types of moving averages, but the question is, which one is the best? This is what usually people ask me in webinars, that okay, which moving average is the best one for us? I would say depends on your actually charts, on your time frame, on your actually trading instrument that you trade. It depends on these factors, but let's say with this explanation, now you know which one is more sensitive. So if I want to see the recent price movement, I would go for the linear weighted moving average to get the actually very fast signals, for example, from the market. Oh, but if I want to only check the long term and just to keep and hold strategies, I would go for the one that filters the short-term noises in price movement. That would be the simple or exponential or even smoothed moving average. But one of the most common moving averages that many people use, many traders actually use, is the exponential moving average, because you see, usually the exponential moving average is staying between the linear weighted moving average and a simple moving average. In this case, it's would helpful because it helps you don't miss any trading, let's say, opportunity when a breakout or something like that happens. Also, it filters some of the noises, and then it doesn't confuse you with a very early signal that might be fake. So that's the benefit of using the exponential moving average. But if you want to be always to be updated about the price movement, it's recommended to use the actually a linear weighted moving average. But which one is the best? That's the actually very important question that we are get there in a moment. Moving averages in practice. Okay, we need moving averages, or let's say the reason for using moving averages instead of just looking at the price is due to the fact that in the real world, aside actually, let's say in the financial market, the trends do not move in the straight lines. Okay, so identifying the market trend would be a bit confusing. That's why we want to use the moving averages. But in that case, the best moving averages would be the one that gives us the better picture of market trends. So to identify the market trends, as a theory said, let me just remove them and stay only with this exponential moving average at this time. As theory says, we know as long as the price is above the moving average, we expect the price continues to go up, or we can say the price is in an uptrend. And as long as the price is below the moving average, it means we can expect the price to go lower, or we can say the price is in a downtrend. Each moving average that reflects this fact to us better, we can actually use, we can say that's a better moving average, or that's the best one. For example, you can see here when we have a very long downtrend, we see the price is moving down, forming these lower tops and lower bottoms. But sometimes we see the price actually getting further and going above this moving average here. That would be a mixed signal to us because we expect the downtrend, but we see the price above the moving average. That would be confusing. This is the way that I said we need to filter some of these short-term price movements to get the better picture. Whenever you see some conflicts or mixed picture between the indicator and the price, just rely on the price. I would say when you see, for example, here the price is above this moving average, but we see this previous top here is intact, we will give it a more weight to the facts of the price, and we will say, okay, this is our prior evidence to stay in the short market actually. And in that case, it's better to change the period of your moving average to see if, or actually the method of the calculation to see if it can let's say filter all the noises for you to prevent you from confusing in the market. For example, you see when I use the simple moving average, you see these kind of movement may confuse me a bit, because I see, okay, here is something like a top and then the price is moving above this top, so I would be confused with the reversal, but in continue you can see there is no reversal, and this is just a price noise. This is the fake, let's say, movement, and then we can say this downtrend is intact. And also when I use this linear weighted, but when I use this exponential moving average here, I can say it reflects to the price fastest than the other. Excuse me. And also we can play with the period and then put a longer period on your moving average. In that case, you see we can filter some noises around here. So, as theory says, as long as we are below the moving average, we are looking only for sell position. Okay, we don't buy when price is below the moving average, and also vice versa. We don't sell when we see prices above the moving average, because we can say the long-term trend is upward, or this is a long-term uptrend, so it's not good to trade against the trend. So when we see the prices above the moving average, we're just looking for the buy positions. Moving averages have more to say. This is just the way that we can use them to identify the trends. We can also use them to measure the momentum of the each movement, upward or downward movement. For example, the slope of the moving average reveals a very important information to us. You see here, for example, let me change it. Yeah, for example, you see here, this is the when you see the moving average is ascending in actually is ascending sharply, as price ascending sharply or moving up sharply, you can see the momentum is gaining here because the moving average. But when you see the moving average is a bit flattening, something like here, we can say that okay, we can expect some range in the market, as we see the moving average is flattening here, but then actually is getting a slope, and the steepness of the moving average increasing. We can say the momentum of the prior trend in the market is increasing or is gaining. So that's the way that we can actually identify the momentum of the trend by looking at the moving averages. For example, if we go a bit further, you can see here during each correction, if I zoom out a bit, you can see here during our connection when the price comes down, the slope of the moving average decreasing, which means the momentum of the this uptrend is losing. And in contrast, when you see the sharp movement just begins to persist from the price, you see the slope of the moving average is gaining. See, which means we can measure the momentum by looking at the moving average. Another use of the moving average, which is very important, is we can see if the price is going to topping or bottoming the market with the distance from the moving average. For example, you can see here each time price actually go down, and then this moving average here reacts as a firm support, as a reliable support level, and then the bounce back actually happens, and we see the price going up in a distance of the moving average. Okay, when the price is gaining momentum, it's going more far from the moving average. But when you see the trend is actually is waning, you see the distance between the moving average and the price decreasing. Like here, you see, when you see this is the range market, and also you have a positive slope moving average here, and we can say we are in an uptrend, but we see the price is in a range bounce, and there is no momentum in the price movement. So we see the distance between the moving average and price is decreasing as long as the price actually losing its momentum. You see, and here we see another let's say bounce back just happened, or let's say pullback happened, and then the buyers find the opportunity here to move the market higher. And then when the market is trending, you see the distance between the moving average and price is increasing. From here, you see this distance is increasing. It's even to this period, we know after each time that the price moves too far, there might be some breaks on the momentum, and then we expect the price back to the moving average again, because we know the moving average is showing the average price movement for a specific period of time. So we can say when the distance between the price and moving average getting too far, we can stay away from the market to see a correction. That said, we can find the best trading occasion when the price is going to rebound from the moving average to keep the trend actually intact. It means if you want to go for actually for long, or let's say for a buy position, when you see the price is above the moving average, don't go for a long position when you see the distance between the price and moving average is too far. Wait to see a bounce back to the moving average, and then look for the best trading opportunity to buy the market. Also, we have the same story on the downside when you see actually the slope of you see in range markets the moving average is flat and is flattening, you see a steepness, and you see the price is just moving in a range. And then when the downtrend gaining momentum, the price moving below this moving average, you see the negative slope of this moving average is increasing. And then with gaining momentum in the downward movement, you see the distance between the price and the moving average just increased. And then when each time that the downtrend losing its momentum, you see the price just comes back near to in the vicinity of the moving average, and then after a bounce back, let's say, continue to gaining momentum again. This is how it works in financial markets, because the psychology of the market is based on the fear and greed. People fear when they see the price is too far from its average movement in the recent period of time. They say, oh, okay, it's too aggressive, so it's better to stay one step away of the market to see what will happen next. And then when they see the price back to the home, back to the average of the let's say the recent period of time, they said, okay, we know we have a downtrend because the price is below the moving average, and now we know the price movement is not aggressive and it's moving in a very reasonable way. So that would be a good actually place to look for maybe a sell position and go just with trend. You have to be with trend all the time. Don't go against the market, because we know the market is always stronger than all the participants. Unfortunately, we are a bit out of time, but I'd like just to show you one more thing for today. One of the common strategies of moving averages is the dead cross and golden cross. So far, we just talked about the relation between the price and the moving average. But now let's talk about the relation between the moving averages. One of the common strategies that many traders use are the is the crossing over strategies. They are very popular, and many people actually like them to apply them on the daily chart and finding the trading opportunity based on them. In that case, we can generate some trading signals when we see a crossover between moving averages occurs. Before that, let me explain something noticeable about the period of moving averages. Short period of moving averages, they includes less number of data in their calculation. It means with the short-term moving averages, we just look at the look at the recent price recent prices as much as possible. As longer its length, the more data points that are included in the moving average calculation. Okay, which means the less any single price can affect the overall average. So sometimes we can combine those long period moving averages with the actually short period moving averages. Which one of the most, let's say, well-known of them is this? Let me just change the color of this to 100 period moving average to black. And let me just explain you. Each period means one candlestick. Doesn't matter what time frame you are using at the moment. Okay, each for example, it means when I choose the 200 as a period, it means, and I'm in a 1 hour time frame, it means the formula, the indicator includes the 200 candlestick or 200 trading session in the formula to calculate the moving average or calculate the average price of these 200 actually data. So if I move to the daily time frame, you see this moving average showing this moving average is showing the average of the price during the past 200 days. Okay, because each candle represents 1 day, but in 30 minutes, each candle represents only 30 minutes of the market. So that doesn't matter which time frame you choose. The calculation is the same, and the price data that included in each one is just based on the number of candlesticks. Okay, you see here we have the 20-day moving average, and let me apply a 50-day moving average. Exponential comes in a red line to be more obvious to you. Okay, the first the bullish actually, let's say, signal that we can generate from crossover between the moving averages, we consider these crossovers as a signal. Why? Because we can say, okay, when the average, the short-term average of price movement goes below or goes above the long period average of the prices, it means something is happening in the market. If we see the crossover of this is the short actually moving average, or the fast one, which just let's say reflects the very recent price changes, and this black one is the long moving average, or let's say the slow one, which reflects the longer period of data of price movements. Okay, when I see the fast MA or my short moving average crossing below the longer moving average, I can say the recent data movement or recent price movement is gaining momentum. Okay, because I see the average of the recent data is moving sharply below the longer moving average. When I see the crossover is in the downside, I can say the price is gaining the negative momentum, or the downtrend is more likely to happen. This kind of signal actually is generated after that we see the price crosses below the moving average. For example, if we look at this from the first, you see at the right corner of my screen, you can see we are just going to follow the price movements. Yeah, that was here. Okay, for example, you see here, if I follow the price, I see the first price just fell below the long-term moving average, which is a kind of a signal, but I can't be sure that this is the noise of the market that is going to be filtered by the moving average later or not. This is something very serious is happening in the market. In that case, I need to follow the price, and then you see the distance between the short moving average and the long moving average is decreasing. Okay, when there are this convergence between them shows the price movement is losing its momentum. Okay, and if we go a bit further, we see, as we said as a theory, we know when the price is below the moving average and price is making lower tops and lower bottoms, this is a downtrend. Okay, so here when I see this lower top occurs below the moving average, I can say for sure that this is a downtrend. This is a downtrend based on the theory of the technical analysis. Okay, and then I can go for shorting the market, or let's say opening a sell position, but you might not be sure yet. So if we follow the prices, we can see finally this crossover happen when this short moving average crosses below this long moving average, and we see the price is this distance from these moving averages. And before that we had this let's say the lower top here. This is the most reliable trading signals that we call it the dead cross. It means when the 50 daily the moving average crosses below the 200 daily moving average, it means the market is going to start a very long-term downtrend. We call it the dead cross. Okay, and if I follow the price after that, you see For example, any kind of position that we would have opened at this, for example, levels, you see, you can expect a very, very solid profit comes to you. And you can see the price as it started a very, very solid downtrend in a long-term basis. While you see the price just crosses above this short moving average or this fast moving average, and then this is how we can identify the range in the market. This is the situation that we have not been trading at all, because when you see during a downtrend or uptrend, you see the price is not below the 50-day, but it's between the two moving averages, and there is a convergence between the moving averages. You can see the very, let's say, appealing range in the market. In this situation, we can't, we can't expect any trading opportunity. Okay, we just have to see a very, very clear trend in the market, and then we have to go with a trend in the direction of the trend. For example, here again you see the price is trying to move downward, and the distance between these moving averages is increasing, or let's say they are diverging in the market, while the price is falling below them. And this is another downtrend. You see, this is what we call the dead cross in the market, and you see this is a very, it doesn't happen a lot in the market, but it's one of the most reliable trading signals. On the other side, we have let's say the golden cross. The golden cross is just the opposite. The golden cross occurs in the market when we see the 50 moving average crosses above the 200-day moving average. In that case, for example, you can see here, firstly, we see the price has crossed above the both slow and fast moving averages. But don't forget to recognize the uptrend. We need firstly to recognize the higher tops and higher bottoms. You see now the fast EMA or the 50-day EMA is above the 200-day EMA, and also we can see the price has formed this bottom, this top, and then this kind of higher bottom, and finally this top. In this situation, we can expect to begin an uptrend. This kind of signal here, this crossover called actually golden crossover, and you see the price is has just started to move on and go higher, and a very long-term, let's say, uptrend has started. You see in this distance of the price, but after that, that's why I told you every time, whenever you see a confliction between the indicator and the price, give the priority to the price. Okay, when you see the market can't go higher than this last top here, this is the end of an uptrend. Okay, it might be a range market as a pulse during an upward movement, or it might be a correction, or it might be a reversal. there are three possible options, okay? But we don't want to put our money at risk to see which one is actually correct. In that case, it's better to just get out of a trade. But if you follow with the price, you see after some correction, the price, because we see still this this fast moving average is above the 200-day moving average. So the signal is intact as the uptrend is intact. So we can see the price is moving up. And we call this is the actually golden cross trading strategy. Okay, let's back to our presentation. Very good. I think for today, that will be enough for today. And I would appreciate to have your question if there is any, and we will get to answers shortly. So please please send me your questions from the question tab on your screen. Okay, very good. Anyway, thank you so much for staying with me till the end of this session today. If there is no question here for now, I'm going to close this session and end this webinar. Anyway, let me just write down, thank you so much. Thank you for your good comments. I'm writing my email in the case that you have any question about the market, about your trading experience, or anything that you think I could be any of help. I appreciate to be with you. Thank you so much, everyone. Wish you a successful trading day. Enjoy your weekend. Thank you and bye-bye.